Okay, here we go. We're now live. And thank you very much for joining us today, everybody. We have Dave Hendricks from Vertalo here. We have Grant Gulovsen of the Gulovsen Law Firm. And we have Jeffrey Wernick, one and only with us today. And the topic for our discussion while we have that together is initial exchange offerings. I think this is has been a lot on everybody's minds recently in the industry because it has been seen as like a reincarnation of initial coin offerings. And I would like to start perhaps by asking you to tell more about your idea of what actually initial exchange offering is. How do you see this trend? And then we'll go from there. And since like Jeffrey has already been talking since before we started, I'll ask Jeffrey to first comment about this one, and maybe also tell a couple of words about what his meeting in Congress in Washington, D.C. that Jeffrey attended lately.
Well, I think to talk about the one is I first have to say I'm not an expert on IEOs. So the specific details of IEOs I'm not really expert on. I've spoken to several people who are in the process of negotiating to list an IEO, and from my understanding of it, basically they're raising money. They're raising a small amount of money than they did in an ICO, and part of the money that they raise has to be used for quote market making activities. So they somewhat preserve the price, and if the price is not kept stable, then they lose all that money that's in the reserve. And it's supposedly, from what I've heard from people, very expensive. The people who help you facilitate with the exchanges to get listed are charging. I've been told they're getting somewhere between 10 to 15% of the amount of tokens, which is really big. If you consider that if a company does back in the days when managements were doing what was called management buyouts or leverage buyouts of companies, typically the stock option grants to the senior executives of the company that were responsible for operating the company. And if they were successful in operating the company, they would get grants of around 10 to 15%. So basically now you have a broker listing you on an exchange that's getting about as much money as bringing in a whole management team to turn around the business. And so they're saying that someone who just introduces you to exchange is basically creating as much value as people who manage a company and make it profitable. That's just, I think that that is so completely absurd. And it talks about how shitty the ecosystem is when intermediaries who help put people together can make that type of money. So
but let's peel apart that percentage though, Jeffrey. If that 15%, okay, that might sound like a lot, and it may be. 10%, however, as a fee is actually just a few basis points higher than a high quality broker dealer does. And so if you're going to raise money through a broker dealer, you're going to expect to pay 7%, and that's net of other marketing expenses. So
you pay a certain percentage of the funds raised. You don't get 10% of the equity raised. You get a certain percentage of the funds raised. So it's very different to say. It's very different to say I get 10% of the equity value of the company as opposed to getting 6% of the funds raised. So
if that's the agreement. If that's the agreement, right? I mean, again, with a broker dealer, they can make a choice to take a position in equity if they so chose to do so. So,
but the equity would be significant reduction of it. If I'm raising, if I'm raising $100 million for a company worth $1 billion, I'm getting percentage based upon not the value of the company. I'm getting the percentage based upon the amount of money raised. So not the total valuation of the company. If I'm doing an M&A deal for a whole company. I'm not getting 7% of an M&A deal that's based upon the whole valuation of the company. So it's very different when I'm raising a percentage of money than that money.
The simple point that I'm making, I think, is that if you look at an arbitrary percentage, you have to ask yourself, what am I getting for that? What's being exchanged for the arbitrary percentage? I don't disagree with you that there's a big difference between getting a fee, okay, and then getting equity. Those things are much different.
And maybe
And
we
I
should
think
also get, sorry for interrupting, Grant's
Yes.
perspective, because Grant being a lawyer, I think this will be interesting to hear
What
what
do you
you have to
need?
say about this.
Yeah, and Grant also, well, the article that he wrote, we are pretty critical on the whole concept of an
Okay.
exchange offerings.
Yes.
And
Sure.
yeah,
Yep.
maybe if we take a step back and maybe introduce, the core points about the whole IEO concept, what is
Sure.
about, and why are you so critical about that?
Let's see if I could I missed, I think, some of what you were saying, but just to sort of go over what the basics of what an initial exchange offering is, I can start with that and then go from there. Is that what you'd like me to do?
Yeah.
Sorry. Okay. For people who are unfamiliar with the initial coin offerings, the ICOs, I'm going to assume that most people watching this have some knowledge of how those things work. But for the main difference between an initial coin offering and an initial exchange offering is that instead of being managed by a smart contract, which is how the initial coin offerings are handled, the distribution of the tokens, the exchange offering is managed by a centralized authority or the exchange. One of the major benefits that people often talk about with initial exchange offerings is the fact that with initial coin offerings, very often the tokens never even got onto an exchange. Now, that presents sort of a dilemma from a legal standpoint, because if the purpose of the tokens being purchased was to get them on the exchange, then that almost by definition made them a security. But that issue aside, at least now, people know when they quote unquote invest in an initial exchange offering that the tokens will in fact be on an exchange. Supposedly there's a guarantee there that as long as the money is raised, then it will be listed automatically. So, I mean, there's definitely some significant benefit from that perspective, I think.
What would you say about this, Jeffrey? Do you think that still this benefit can outweigh the certain disadvantages that you have just mentioned with Dave?
Jeffrey looks like he's on mute, so he'll have to unmute himself. There we go.
Hello. Yeah.
Yeah.
I think, anything that's being traded for its speculative value as opposed for its utility. Therefore, being on an exchange should not be that important, because essentially its use is not as a speculative asset. It's used for its use inside the network, and its value is defined by how it's inside the network. And if you look at what the SEC guidelines are on what is not subject to a registration requirement, it's basically what they've mentioned is a permissioned chain, not a permissionless chain. That the token design, by design, has to be a token that's expected to either be stable or depreciate slightly in value, and should only have value inside the network. So so being listing on an exchange should be an irrelevancy to a real utility token, because its value should not be defined by speculation. Its value should be defined by its use inside the network, inside the system. So
I think you're completely correct about that,
that,
Jeffrey.
So the fact that there's such a concern about even before, and also you can't use any of the proceeds to actually build out what you say you're building out. It already has to be built. So it can't be used for the purposes of doing a project. You have to have a project, and it has to be bought by people who find utility in your project, and they're using it inside the network. So if people are saying these are utility tokens, all these exchanges are doing basically securities, and they're poorly designed securities. So there's a difference between a well-designed utility token and a poorly designed security. So the IEOs and the ICOs are poorly designed securities, and they are securities because to everyone who's buying them, they're not buying them for use in the network, they're buying to speculate on its value. And that's why listing on exchange is relevant to them.
And I will probably address a question to you, Dave, now. So if we, I would say that it is securities, and if we talk about it as listing, for example, security tokens and fundraising the same way, is it possible, and does it even make sense this way to deal with token securities?
To issue securities using an IEO?
Yeah. Well, if they are securities, in fact.
I think that as soon as you sell something that has the potential for gain, and it makes it a security, whether you think it is or isn't. So, the question ends up being kind of moot. However, I think that one of the funny things about the IEOs is kind of ironic, and it speaks to Jeffrey's excellent point. If you're putting these on if you're listing via an IEO for a utility token, you're really actually making it a utility for the exchange rather than you're making it a utility for your own ecosystem. I think it's a very, very clever mechanism actually to create utility for exchange-based coins. That's what in fact is happening here. When someone makes runs an offering on an IEO, oftentimes they are forced to run it in an alternate chain. In this case, Binance, and I think this is ridiculously clever. It's very similar to how clever Ethereum was in creating ICO-based smart contracts. By having folks list on Binance and using Binance coin, they're jump-starting the utility of their own chain. It may be to the detriment of the project or not. I mean, the project gets to raise money after all, which is the goal. But it is in fact creating utility. It's just creating utility for the exchange more so than for the ecosystem of the entity that's raising money. I think that's the most kind of meta, mind-blowing thing about this IEO stuff, is what it's doing to create competitors to Ethereum, frankly, for fundraising.
But who do you think are the ones who benefit most from IEOs? Are these projects or exchanges or actually investors? And it will be also interesting to know, like, Grant points of view on this, because there can be also some really legal obstacles.
I'm not going to let Grant. I'm not going to let Grant answer first. So sorry, Grant.
That's right.
I think that oddly enough, the IEOs are super interesting. I can see both sides of an IEO, and I think that IEOs certainly benefit exchanges. Let's cover that off first. If anyone here disagrees that IEOs benefit exchanges, please raise your hand, because it seems to me that IEOs first revitalize exchanges that might be moribund from lower trading and less volatility. So check on it's good for exchanges. Second, what about the projects? Are IEOs good for projects? In the abstract, yes, because they help projects raise money quickly okay, so you pay 10 or 15%. That's a liquidity discount, okay? Let's just think of that as another form of liquidity discount, and they're gonna pay a liquidity discount to run on an exchange. It's more expensive maybe than going through a broker-dealer, but it's less expensive in funny ways than raising from VC, who's going to take 20% equity or 25% equity. So it's kind of a middle ground between broker-dealer and VC in terms of what it takes from you. So the third question, and I think that Jeffrey and Grant would have a lot to say on this one, is does it benefit investors? Well, it benefits savvy investors who can pull a trigger quickly and get out of a deal, or it benefits investors who can tell the difference between a crappy project and a real project that might grow in value and price over time. look, not every single ICO went to zero. We know that. And that's the same thing for VC investments. Most VC investments suck. So, that's, I think it can benefit all three, actually, funny enough, if done right.
Can I answer now, Dave?
Yeah.
No. Last word here.
My thoughts on that are, I think the points that Dave made are correct, but the critical component of that is if done right. I think that's really the big question. One of the concerns that I have generally about IEOs is the lack of transparency, because it's very difficult to tell what exactly is going on. There are a lot of rumors flying around that they're not what they appear to be, and I don't necessarily want to speak to those during this program, but just more generally, nobody really knows if they benefit, who they benefit other than the exchanges, because it is absolutely clear that the exchanges are benefiting from these things tremendously. And if you look at the funds that were raised last year, ICOs, the trend was downward pretty much by the time you hit December. Now I think in the first 4 months of this year, the total raised was for ICOs, I think, is about 100 million. And whether or not those numbers are even believable is debatable. But that's, that would have been considered a small month last year, over 4 months. So obviously the ICOs dying out were what inspired the IEOs to come to pass, because that's a lot of these exchanges were making inordinate amounts of money from listing fees that unfortunately are no longer, we're no longer there from their perspective. So IEOs are a fantastic way to bring funds into your exchange. And especially if you have an exchange token like Binance and some of the others, it's even better. It's sort of like it's network effect, I guess, because people have to buy your token to buy the project token, and it's just money coming after money. So it's great for exchanges. Projects, I don't know. I mean, I personally have not represented anyone who's done an IEO. I've talked to a few prospective clients who are considering it. My experience is more with ICOs, ones that actually did raise money, and I just find it to me, just hard to recommend them to anybody, just because I don't trust the data, because there is no data. That's sort of the way I feel about it, as far as how the projects are doing, how much of the actual raise are they getting. There's just no publicly available data that I've seen as to what the answers to that are. And then also, as far as the just talking very briefly about the investors, whether you're talking about the investors in the initial offering or the subsequent pump, I don't want to call it a pump and up, but the price of the token going up post the closing of the offering, and then in almost all cases, with I think maybe the exception of the BitTorrent IEO lately, at least, the value has pretty much not gone down quite as quickly as the tokens from ICOs did, but they're still pretty much in the negatives across the board. So at least for anyone who got in right after the token sale closed and maybe got it on the high when the price was maybe 3-4 times, they're all bag holders now. And presumably at some point in the future, maybe those projects will have been able to keep enough money from the raise to build or do something that increases the token's value over time. But again, we don't really know how much they're even getting to keep. So there's just a big question mark over the whole thing. That's probably my biggest concern that I have about them.
And
is everyone's expectation, however, that things are supposed to go up after an issuance? Because you take a look at Alibaba. You take a look at Alibaba. Alibaba dropped pretty strongly after it went out to market, and now Alibaba is way up over its issuance price.
Right.
Here's one benefit. Let's talk about another side. I'm an entrepreneur. I run a tech company. I have to raise money. That's kind of what I have to spend my time doing. It's painful, but it's what you do. One of the benefits to the IEOs or any fundraise is that it keeps a project alive. If it doesn't turn into Lambos and sailboats, it keeps a project alive. And if there are clients for that project, they're probably going to directly benefit from a project keeping itself alive through whichever method of fundraising that it uses. And these things, if they're done right, they pay salaries, they pay back lawyers. Even people like you, Grant, might even benefit from these things. And then and then investors, if they're savvy, they can pick these things up. I don't think that any investment, I'm sure Jeffrey has an opinion on this, and I'll shut up and I want to hear it, definitely, that people should not expect in any investment they make to go up automatically. It doesn't. People go out to public markets because they're looking for retail investors, and they have an information asymmetry edge there. And it's not every company ends up being Zoom, okay? Which, by the way, was underpriced. Look at that one, right? The last private valuation for Zoom was $1 billion. And then 12 months later, suddenly it's worth $20 billion. Pretty amazing. I don't know. You never know.
About this Zoom technologies, when like some investors stupidly bought actually stocks of a different company. I think Jeffrey sent us this link, and this was pretty funny, but I just wanted to mention this. And Jeffrey, what would you say on what Dave said?
Well, first, I'll preface what I say by saying is I do not believe in any form of regulation whatsoever. So, so whatever the problems are in any financial instrument, I don't expect government to come in and be the one that we should look to solve our problems. I think that one of the things I learned when I left the University of Chicago and went to Salomon Brothers. You have 2 alarms. I gotta shut my alarm off here in my house. 1 second. And one of the things I learned, I traded a percentage of the partner's capital when I got to Salomon Brothers. But I sat on the trading floor, and one of the expressions I learned quickly that people said on the trading floor of Salomon Brothers was, I learned the expression, a fool and his money are soon parted, and our job is to separate fools from their money as quick as possible and allocate it to smarter people, and that's Darwin, and that's good for everyone. So that's how I learned how people in Wall Street saw their view of the world, is if we could pick you off on a trade because you were stupid, we were basically doing God's work. So, because we're getting it out of dumb hands and putting it into smart hands, and smart hands will use the money better. So,
this is pretty presumptuous.
And I didn't really care very much for that environment. I think, again, going back to the issue, is if I'm trying to design a good utility token, an attribute of a good utility token should be that it should be pretty stable in price. And if it's not stable in price, it will not be effective in performing its utility, and the project will fail. So if I'm raising money to build something that's supposed to be of utility, and I'm raising it by creating a speculative asset, I'm pretty much guaranteeing my project will not succeed. But that's ultimately people's choices. I can make if the appeal, and this is my concern, and I don't want to stop people from the right, I do agree that the biggest beneficiaries of this are people like Binance. I don't like to call them exchanges because they're not really an exchange. They're a broker-dealer, they're an investment bank, they're a high-frequency trading operation, they're a hedge fund, so that if you take a look at what we traditionally define as an exchange, okay, they're certainly doing significantly more than we. So if you took a look at the whole range of activities they actually perform, they're also a venture capital shop. They have laboratories. I mean, so that their ecosystems embedded with so many conflicts of interest. But they're conflicts of interest, and everybody's informed about them and are making informed judgments. And if they're not, it's their responsibility. I do believe in caveat emptor. The buyer has to be responsible. So if a buyer wants to buy an instrument that it's basic by design, it probably is likely to fail, and they're still willing to fund it, and they know that they're not entitled to any sort of information disclosures, and they still want to invest in it, they still have the right to do that. So I mostly speak out to provide people information, because most of the people are talking about how wonderful these things are. And so for someone who's going in, who's ill-informed, not sophisticated, who heard other people tell stories about how quickly they made money, so they think they're going to jump on the bandwagon and make money like all the other people who made it in front of them. I basically started trying to speak out, so at least there'd be a story that would hopefully encourage people to think better and more prudently about it. Think about how many people went into bankruptcy because they got into the home flipping business in the 2000s. So, people with middle income people, said, oh, homes are going to go up forever. Let's buy one home and flip it. Let's buy a second home and flip it. Then buy a third home and flip it. And then all of a sudden you have middle income people with 10 homes, all this mortgage debt, and having everything foreclosed and their life savings were wiped out. So at the end, are they responsible? Of course they're responsible. But meanwhile, they only heard one story. You can only make money. Even Ben Bernanke was telling them that story. Okay, you're only going to make money if you own a home. So there are enough people lying that typically, in our system of supposed justice, you hear two sides to a story, and the role of the courts is to mitigate information asymmetry. So we don't have enough players out there in the traditional capital markets. That role is performed by short sellers. So you have short sellers out there providing information to counterbalance all the lies and bullshit from Wall Street. In the crypto industry, there is essentially no short sellers. So there was nobody out there telling a counter story. So I tried to make myself the person telling the counter story just to provide information. So, I agree with almost everything, everything I've heard. It's a very, I think it's a very, as far as fintech innovation, it's a very creative tool. It has many tools to separate stupid people from money and whether people think it's a scam or it's legitimate really is a function of, is the person raising money sincere in what they're doing? For me, anyone who asks me for money who expects that they have no accountability is a scammer. So even if they have the expectation that that's a legitimate way of raising money, that write me a check, and I'll talk to you when I want to talk to you, and I'll tell you what I want to tell you. And by the way, I'm not disclosing to you that I've designed an instrument, that's going to make my project less likely to succeed, but at least it's going to give me a chance and keep me alive longer. But you have to figure that out, because I don't want to tell you, because it's adverse to my ability to raise money. So if people are that utilitarian, I think that's a sad statement about human nature and about us. So from a legal point of view, yeah, people have the right to be scumbags. But I hope people choose not to be scumbags.
I think.
Right. So
Yeah,
go ahead. After you.
No, you say first, and then I'm going to ask the question, probably one of the final ones for today.
Yeah, so there's always a caveat emptor in these sorts of things. The question is, how will IEO offerings do? That's the most interesting thing. Will it attract a different kind of issuer than an ICO? My understanding and what I've heard is that the exchanges are a little bit more are placing a little more diligence hurdle in front of issuers than what happened with ICOs. And the difference with ICOs versus IEOs is that ICOs are essentially self-issuers. I work with self-issuers every day, and they are cats and dogs. They're very inconsistent from one to the next. It's very difficult to diligence them because everyone's got different documents and different lawyers and different thises and different that's. So individual issuers, ICO is all about self-offerers issuing their own coin and then paying exchanges, or whatever you want to call them, broker dealers, to allow those to be sold. The exchanges, however, may have, and this is complete speculation on my part. I'm not party to their conversations, and I'm hoping, and hopium is an awful drug, that the exchanges are saying, hey, look, we're doing IEOs because we want to have more activity on our venue. In order to have more activity, there's got to be something worth trading. So we're going to look for deals. We're going to look for companies that are worthy of trading. Maybe they don't go to zero. Maybe people don't come with torches and pitchforks. I'm hoping that there will be some competition by exchanges, just like there or whatever these chains are called, that rival the competition between NASDAQ and New York Stock Exchange, for example, to land the best listings. And that's a real thing. So I don't know. I'm kind of withholding and suspending disbelief for a little while to see what happens here when, as you see the difference between direct listings, which is IEO, and self-offering, which is ICO, and see if it breeds more quality. I don't know yet. I don't know whether it breeds more bullshit or not. It's hard to tell.
We've already seen exchanges acting more responsible, so to say. That I've seen, I think it was Bittrex or Bitfinex who actually stopped the IEO before it went live, because the company was issuing the token announced that it was closing the partnership that was vital for its development. And the exchange actually said that we think that it's going to affect investors, so we're not going to do this. And also, so moving forward to one more question that I have is that actually projects who are looking to do an initial exchange offering, they already need to have money. So it's not, pre-seed startup who can raise like that, like projects did on ICOs. So they need to have some particular already money. And one opinion that we've heard is that this fundraising method best suits operating businesses and already profitable. So a token in this case cannot be, blockchain token in the network that this project utilizes, but a token representing a right to receive a particular service or product that the project will do, already does. So it's like a token representing a right. So how does this look legally, and can this be a way for, transforming point for the whole IEO concept?
I guess I can take that one. When you say that the token represents a right to a service, and that it's also, you said it was not critical component of the network. I personally think those are the same things. When a token just represents a right to something like equity or a right to profits, a share of profits, then it's not necessarily part of the network. But I do believe that, I think it just depends on how you define its use on the network, and that's my understanding of it. Because I think that if it does have as a right to access services, that actually is part of the network. So that's my sense of it. So I don't know if it really changes it in that regard. Generally speaking, I initially thought that the fact that it was being listed on an exchange was made it more likely to be deemed a security than something like an ICO, which might not end up on exchange. But I think that over the past several months, I think my opinion on that has modified somewhat to be more consistent with what Dave and Jeffrey were saying, where at least it shouldn't have any real impact, as long as there is something that the token holders can use the token on the network, the MVP, whatever you want to call it, when they receive it. Then I think it does make the fact that it is going onto an exchange less important. So, but I do believe that the MVP has to be an important component. As far as other legal differentiations between the IEO and the ICO, I don't necessarily see, again, all I can speak about is the hypothetical, what we're supposed to believe is actually going on with these things. And as I've already indicated, I have my doubts because there's just no transparency. And I think that personally, and this is something that I've taken just since I've been involved in crypto, I see the benefits of I just say greed is good, to use a catchphrase. But the problem obviously is when that's coupled with things like fraud and corruption and lack of transparency, and when just complete informational asymmetry where one party knows everything and the other party knows nothing, then markets just don't work. And I think that's a lot of what's going on with ICOs and what is also going on with IEOs. There's been some disintermediation that's occurred in the transition from ICOs to IEOs because you don't have all of the companies out there like the rating services like ICO Bench, the experts, the ICO advisors, all those people who were sort of taking their cut. And now those are all gone. So there's actually been quite a bit of disintermediation moving from the ICO to the IEO realm. But the problem, though, is that it's all completely centralized now. And we're trusting that the data, the information that's coming out of these exchanges, which is basically none because they don't let you see the actual transactions that are happening. So you just kind of have to take the word for it. Things are happening the way they are. If everything's being done properly, then I do see them as being generally better than ICOs, really, for all the reasons that have been stated so far.
And we have a question in the comments. Alex Fermani is asking, a pretty good question, by the way, that a number of companies who are looking to do an IEO have already done their ICO, and now they want to do their IEO on multiple exchanges, sometimes simultaneously. What do you think about this? Like, how does it look from a legal standpoint to Grant?
I mean, each raise has to be considered in its own sort of, in the context of what's being raised. And mostly, I wasn't aware of that. I didn't know that. It doesn't surprise me that companies that had done ICOs wanted to raise more money, just like additional raises in a startup, whether it's going from seed round to Series A, B. So there's nothing, I think, inherently wrong with doing that. But the fact that they want to do them, is it multiple exchanges at the same time? I don't know if that's what the question is. Again, it really just depends on the circumstances. Potentially it could be less like a security because if they did use the money that they received from the ICO to actually build something, and where people can use it, then they've sort of gotten past that threshold. And I think in that context, it would be less likely to be deemed a security. So, I mean, I don't think that's any better or worse than anything else. It just depends on the facts of the particular case.
And I have a question for Jeffrey here. I understood how this looks from legal standpoint, but from the point of view of ethics, how do you say, Jeffrey, is it actually appropriate to do an ICO, then do IEO on several exchanges and something like this?
Well, as someone who is an investor and a value investor, I mean, the first bet you're making on are the quality of the people you're betting on. So the first thing I look at in making any investment is the character of who's asking for money, and my evaluation, not only their character, but their competence. But the character comes first. So once somebody establishes themselves as a liar, there's not much more I want to know about them because they failed the character test. And once they fail the character test, then I don't want to know anything anymore. So I would be curious about, like, these people who did an ICO that now want to do an IEO. I'd be curious about what kind of disclosures they're telling people about what they did with the proceeds from the ICO. How did they spend their money? Who's validating how they spent their money? What value they delivered for the money they was spent? And what do they need the incremental funds for? And how you can monitor that they're going to use those incremental funds for the intentions and purposes that they say they do. If anyone really has respect, if you think about a relationship with people, how many people you sit back and say, if someone really respects me by telling me that, give me money, okay, and I want to preserve the right to preserve a significant information asymmetry. So I don't think any decent person engages in a relationship where they're taking your money and or having you assume a risk that doesn't adequately disclose the risks and doesn't keep you adequately informed. And you shouldn't need a regulation to do that. People should do that. And an investor that doesn't expect that probably is not a very smart or good investor. And people have the right to be stupid investors. And I'm not going to stop people from being stupid investors. As again, what I said is, at least in the capital markets that existed, it was easy to find collateral in shorts and short stocks and short bonds and tell the other side of the story. This industry has almost nobody telling the other side of the story. I know some of these projects that are listing IEOs, in the process already have, because some of them have come to me for advice. So, and my advice I've given to each one of them is don't raise any more money because you don't have a project that you know how to monetize yet. So I understand you have an activity you want to keep doing, so if you go out and tell people, I'm having this activity, I don't know how to make money yet, just give me time and give me money, it might be interesting, but I need more time and money to figure it out, then at least you're being honest with people. So if you're not saying that, you're being dishonest with people. And almost every project I see still does not know how they're going to monetize. When they speak to me and they talk to me about their problems, some of them I give suggestions to, and some of them I can't figure out how they'll ever make money, because I think what they're doing just never will make money. But they're clearly not making adequate disclosures, and they're clearly preying upon a less sophisticated investor, and ultimately this will be bad for the marketplace until there's more information disclosures. And for me, the more perverse thing about this is that initially what were these projects selling? Decentralization and trust. So everything they're doing about the process is centralizing it even more, because now we're making the exchanges centralized institutions, assuming more centralized power. So when Binance on the one hand talks about building a decentralized exchange while they're doing all these centralized activities. So it's all the hypocrisy in the industry, and people who say, I want to do something because I want to encourage a society where everything is predicated upon trust, and the whole process that gets them into raising the money, there is no trust in the process because there is no transparency. We have the issue of Bitphoenix. You wouldn't have to worry what Bitphoenix had to say if their collateral was on chain. If the collateral is on chain, then you don't have to listen to what they say. The evidence is on the chain. So many of these things, people could just put all the activity on the chain. Binance could create a fact where they could have people who want to do an IEO could put the information disclosures in. They could create sort of like not that I believe in DPoS, because I don't, but somebody who does believe that you can create this decentralized DPoS, they can get the big token holders of Binance, as well as some super nodes that are supposedly experts in valuation and stuff like that. The community can vote based upon the disclosures, and the community can vote based upon what kind of the ongoing disclosures they make, and the exchange could have no role in the process of selecting the project, only creating the framework under which projects get selected, and they can do this all on chain so that every step of the process is validated and you build trust. But they don't want to build trust because they want to preserve the option to lie, they want to preserve the option to cheat, and the value of lying and cheating, and scamming is valuable to them, which is why they don't want to put all these activities on chain that could put on chain if they really want to build trust. So the whole purpose of all this stuff is to create platforms where trust becomes embedded into protocols. So that's why it's called trustless, because you no longer have to trust the people because the trust is embedded in the protocol. It seems to me if everybody is a liar who's trying to build the ecosystem that's supposedly about eliminating the need to have to worry about trust, that's very ironic. So Bitphoenix could end the problems tomorrow. They claim that they were 100% collateralized by currency. They could have just held that, they just could have put that on chain, and then nobody would have to guess in the quality of what they have backing up Tether. But they don't. So they don't because they clearly want the right to lie. And it's a valuable option for them to be able to lie. So when people want to preserve an option to lie, and they value the option to lie a lot, it doesn't make me trust their character. And if I can't trust their character, I won't make the investment. Number of times when I've talked about my description of a shitcoin, it's not necessarily because I just think the project is a piece of shit. It's the governance is a piece of shit. So that makes it a shit coin because I don't think it aligns incentives well. And best relationships are about good incentive alignment. So if somebody designs a relationship that's not predicated upon good incentive alignment, for me, that's a shit relationship. And if it's a token, it's a shit coin.
Okay, so can I ask a question though, Jeffrey? Then is it the medium that the money is raised on, or is it the project, which is more important to you?
It's the project, and the form of money raised is irrelevant to me. Okay, it's the value proposition. Whatever currency it's denominated in is irrelevant to me. But it tells me something about the character when somebody says, I want to work on these projects because I believe in decentralization and I believe in establishing trust, and that's why I'm in this ecosystem, is to promote that. But then all their activities are contrary to those principles, then I know they're a fucking liar. So, and that's what they tell me. They tell me that these are their principles, but they're not behaving in a way that's consistent with their principles. So that's why.
Okay, so I want to compare. So let's compare Lyft, okay, to any recent IEO listing. Say just BitTorrent, right? BitTorrent, big user base. It's a big name in peer-to-peer.
Yes.
And Lyft is a big name in ride sharing. What's the difference between those two? One went out, on an IEO, and one went out in a U.S. stock exchange. What's the difference between those two things to you?
Well, the only difference in the things in either one of them is the quality of the information disclosures I'm getting to make a judgment on, how much I can audit and validate of what they've done, and how much I can continue to monitor what their ongoing activities are and what level of accountability they have. So, I mean, for me, I don't care what exchange it's listed on. I care about the nature of the claim. If I have somebody preserving collateral for me, then I want to make sure they preserve that collateral well. If I have somebody who I'm betting on that they're going to be able to run a business well, I want to know enough to make sure that I have enough information so I can, on an ongoing basis, price the risk of what I've acquired. And if they don't make significant enough disclosures, then I don't know how to price it.
Yeah, I get it. Disclosures, I totally get it. So do you think that disclosures are the ongoing responsibility for the listing venue, or do you think that's the project's requirement? And then if it's the project or the issuer's burden, which is what I believe it is, what role does the trading venue have in enforcing that? And how much does that matter?
I think many exchanges have their own, to list on an exchange has their own disclosure obligations as part of listing on an exchange, and has information disclosure requiring it. But ultimately, since I don't believe in regulation, again, I'm using this for me to judge the character of the person asking me the money. I don't care the medium of exchange. I don't care the exchange it's trading on. I don't care the platform it's trading on. I'm judging the person that is asking for a check in whatever form of money they want to receive it. And so for me, I view it as the issuer's responsibility. So I don't want to rely upon an exchange. I want to rely upon what an issuer thinks is appropriate when they say, I want your money, and I want your money. And then I say, what kind of accountability do you think it goes with that request?
Yeah. So let me ask a different way then. If someone chooses to raise via an IEO versus raising from, say, a U.S. Small Business Administration loan, or from a VC, IEO, SBA loan, or VC, any difference to you? If they're all the same, does that change or color your perception?
No, I think from an issuer, I think from an issuer, it's natural that you expect that an issuer want to raise money in the way that's the cheapest way to raise money at the cheapest cost of capital and with as little accountability as possible. So I understand that's the ideal world for an issuer, is to raise money from people who won't ask you a question, or raise it on a platform where it's as cheap to raise as possible and with the least dilution to you. And that's what an issuer should look for. And I don't blame an issuer for looking for that. So, so that's why, if an issuer comes to me, my only question I ask them is, you can go to anyone else. And, so the question is, are you looking for dumb money at cheap cost as possible? Or are you looking for smart money that you might think will help you get richer? So if you're looking for dumb money, where you're just raising money and you don't want to answer many questions and you're looking for minimized accountability in a way that's the cheapest for you, which I understand is a legitimate thing to do, just that I don't think that's a scalable model. I think a scalable model to find dumb investors who are raising money with any level of accountability, I don't think is going to be ending up being that scalable, because I think most of the projects will eventually fail. And we really don't know how many tokens have failed, because the prices on many of these exchanges on many tokens are phony prices, because there's no liquidity in these tokens. So somebody goes out and trades one token and they can move the price 50% in a day. So these prices are not real. On most of the tokens, the prices are not real. I think many of the people that own tokens, can't get out of the tokens because there is no price that they can really sell if they're holding any significant amount. So I think if the founders of every project decided that they wanted to sell, assuming that they held all their tokens that they got at issuance and never sold any, if they all went to sell half their tokens now, I bet you few projects would be able to find any buyers for those tokens. And that you would find that the project is really at zero. And they might be using the small amount of reserves they have left to periodically buy a few tokens to give the illusion that there's a price, that there's an increase in price. And I want to say one other thing too is, I was at a dinner hosted by one of the big funds, in New York, that still had a lot of capital to spend. And I said to them, I was at one of these dinners 6 months ago. You had a list of projects that you loved. You said these projects were great. The token now is 10% of what it was 6 months ago. Why don't you go out and buy the tokens yourself? The tokens are very cheap and you have money, and you say you still believe in these projects. You believed in it 6 months ago. You should believe in it a lot more now. And why don't you buy up the tokens and basically privatize the project, and take ownership of the project again? So they all smirk. I've told some founders, I know you have significant deep pockets. Right now, a small percentage of your net worth, you could buy back all the tokens because you claim you really believe in your project. So it seems to me very cheap for you to buy back your tokens. None of them are, and many of them have privately told me is that they believe the tokens are still overpriced. So they won't tell that to the public. They'll tell me privately that they think their tokens are still overpriced. At least in the traditional capital markets, when companies think their stock is cheap, they buy it back. Nobody's buying back tokens because they know their prices are still overpriced, and they still don't believe in their own projects because they're not putting any more skin in the game. Okay, they're trying to extend their life. It's like an option pricing theory basically states, when I'm out of the money, okay, and I'm deep out of the money, what I want to do is take bigger risks and kick the can down the road. So that's what they want to do. They want to kick the can down the road and take bigger risks because, they're already dead, but they're on life support system. And so they got to go for the grand slam and some of them are even asking for more money. So, and if people give them money, God bless them.
I have a question in this regard, just what you mentioned, Jeffrey, that right now it is said that some exchanges demand some kind of a security deposit, like collateral, to be able, to create a buy wall, to be actually able to support the token price when this happens. So my question to Grant is this actually legal? And then, do you think this is how everything actually works? Because in a more scam way.
Oh boy, let's see. So I'm going to first answer the question that Dave asked because I think I've got an answer that hasn't been brought up yet, and I will answer your question. But the question was what the difference is, and this even gets back to the comment that Dave made about Alibaba. Why I think that's a bad example, because there's a leap of faith that's required in all of these projects, whether they're ICOs, IEOs, whatever it is, because you're not getting any equity. You don't have any sort of a security position, debt position. If the company goes bankrupt, or there's no connection between. There's no way for you to regain any money from the assets of the quote unquote company, because under the terms of the token sale agreement, at least the ones I drafted, there just are no rights for the people that are buying these things. So, I mean, to me, that's the big difference that makes all of these so much different. It's the incentives. And the one thing about IEOs is they do not, from what I've seen, they don't change the incentives whatsoever. They don't they don't align the incentives between the people who are investing and the people who are asking for money in any way, shape, or form. That's always been the biggest problem, in my opinion, with investing in ICOs. And I'm looking at it from the investor standpoint. I don't believe that, personally, that many of these are good investments at all, because there's no way to monetize your investment unless you're planning on doing some sort of a pump and dump where you're just going. The savvy investors, the ones who made money with ICOs, are not the people who hodled. I mean, they're not the people who held their coins. Those are not the people who made a lot of money on ICOs. Time will tell that may change, but I think in many cases that's unlikely. That's very unlikely to happen, because even if the company's incredibly successful, that does not mean that the token value is going to go up, because there's no direct connection between any of these projects, because the way the tokenomics were designed, the utility of the tokens were designed, they're not designed properly to have those things integrated and work together. So you're just basically blind faith that a bunch of other people think that the project is quote unquote cool, so they're going to put their money in it. I mean, I guess that counts for something, but that, to me, that's the only thing that people are really riding on here, unless they're just trying to make out like bandits, which is fine. Again.
So Grant,
yeah.
you know that my job on this thing was to be, this, whatever I am, supporting views that might be disagreeable to other people. But isn't Tesla the same thing? Isn't Tesla basically a bunch of people believing in low or non-emissions vehicles that are run on batteries, and not understanding that they're actually run on coal and on petroleum that just happens to be decentralized? I mean, isn't that a stock that has very low underlying value? I mean, aren't people allowed to believe in companies without underlying fundamentals because they want to support it? Wasn't that part of the whole thing about? I thought that the deal with crypto was that people were funding projects that were not fundable. They were funding vision that was not achievable yet, that their underlying fundamentals weren't important. It seems like we're asking a lot. We're asking for late stage maturity from early stage projects. And I thought the best thing about ICOs, to me, and the reason why ICOs are so popular, was because finally anybody could buy super early stage, early price, pre-proof, pre-MVP, and it combined it with public liquidity, not even late stage liquidity, but literally public liquidity. That's why ICOs are so popular. Now, in order to get that bargain of early stage price and late stage liquidity, you take risk, right? Because there is very low information. So, Jeffrey's against regulation. You're pro, investor rights, and those things are important. But shouldn't we expect a trade-off there? And do we think that everybody is an idiot? I mean, aren't people going into these things with their eyes open? Or is everyone?
No, I agree with you, and I guess I see my role, to the extent that I speak out publicly on this stuff, is similar to Jeffrey's. Is I'm just a voice that's taking the opposite position. That's trying to put out the information that I learn and to try to put things in perspective, to maybe show people that perhaps this isn't such a great idea to put your money into this, if that is in fact the case with a particular project or a particular type of fundraising mechanism. But I agree that people should be allowed to make dumb decisions. There's no question about that. But at the same time, I think it's important to help, just if nothing else, just increase the level of information that's available, so that when people do make that dumb decision, it really was a dumb decision because they had at least, they had been presented with these other alternative facts that may have ended up being true, and they just chose not to believe them. But at least they had the option to listen to them.
I mean, VC is massive, a set of massively dumb decisions, right? 99% of VC investments either go to zero or they have recovery value at best. And then there's 1 to 10% where anything interesting happens. I don't think even 10%. And that as an asset class, it's not returning that well. So, why are we suddenly wanting to? Why do we want to turn this off? Why do we want to? If everyone understands going into this that they're taking a risk, why don't we let people take risks? Do we have to give everyone swimmies before they go into the pool? Does everyone have to, wear a helmet when they leave their house because they might fall down and hit their head?
I do, but I don't know if everyone else needs to do that. So.
Now that you cut off all of your hair, I mean, you still have some of the back, don't you?
Oh, I've got pretty much the same I had before. It's hidden.
I think like your law of friends, the journal of their investors says we're all gambling, and there's ICOs playing poker, anything in casino basically. And I think this pretty much like is very valid what you were saying. But isn't
it's roulette. It's roulette, by the way. It's not poker. It's poker has statistics behind it. Roulette doesn't.
But I think it does as well. Some kind.
Isn't it all come down to incentives? As Grant said that this, like, if you see that everybody knows what they're doing, like people want to invest in early stage projects, they want to invest in early stage projects and ideas, and with IEOs, people want to support infrastructure and also projects, and this is good. And yeah, we think everybody should just go with it. But I think that probably people investing on the exchanges usually have no idea of what is behind the token that they're buying, and they're just looking for this, quick jump in price to quickly sell.
I think I've heard a lot that I've agreed with. One is my whole argument has been that good relationships are predicated upon people having good incentive alignment. So that should be the framework for all good relationships. And it's not mutually exclusive to take risk in a way that incentives are well aligned. So you don't have to misalign incentives in taking risk. So and Tesla, also, as I agree with Dave had to say to some extent regarding Tesla. I shorted Tesla at 375. And then I shorted even more when Elon Musk said he had a deal, because I know it's a character bet. I know he's a fucking liar. I knew he didn't have a deal because he lies. And so I shorted the stock and rolled it down from 380 to 260, and I covered most of my short at 260. So I'm very happy to Elon Musk, and I hope every time he opens his mouth, he lies again and gives me an opportunity to make more money off of his lies. So the question is again, it still goes down to the point is how, in the nature of the risk that people are mutually agreeing to share together, do you make a decision to align incentives while you're mutually agreeing to share risk together? And they're not mutually exclusive. So I'm happy that anyone can invest in anything they want. I'm happy that a lot of young people got an opportunity of basically investing in an asset class that otherwise regulating bodies, Wall Street, would restrict them from having the ability to do. And a lot of young people made a lot of money that they never would have had the opportunity of making if it wasn't for this. And I do think eventually the market will get smarter. So you can only scam for a certain period of time, that in the absence of there being value, that ultimately the scam will be uncovered and people get smarter over time. And I trust that people will get smarter quicker than regulatory agencies will get smarter. So, and the solution that they will find will be more creative and more innovative than what institutions are. So at least to some extent, going back to what Dave said about the IEOs, yes, going out and saying, gee, you know what? To the extent that we're giving an opportunity for some people to scam and pump and dump, what we don't want to see is a complete collapse of the token right after the listing. So we're now going to have the issuer, ensure that. But the beneficiary of that is ultimately the exchange. It's helping to enhance the reputation and brand of the exchange. And obviously that's the exchange's responsibility. And again, I hate to use the term exchange. And that's their responsibility is to the people who hold their token. So their responsibility is not to the people who list tokens. Their responsibility is the people who hold their token. So they're taking decisions that are responsible for maximizing the value of their token, which is their responsibility. So I think a lot of this innovation is good because people are learning. And in the absence of regulation, yes, you have a whole bunch of people taking shortcuts. And for those shortcuts that prove, pretty good ones, they'll adapt. The bad ones eventually will get discovered. It won't take long. It didn't take long from us to go from a boom to a bust in the ICO market. And I assume it will the same happen with the IEO market. My only concern is more, one is from an ethical point of view, and the other is from a philosophical one, is the fact that I really believe in decentralization. And if the concept of decentralization ends up not being pursued because of the example of all the people working on it proved to be scammers, so as a result, we get more centralization, that to me would be a very bad outcome. So I would hope that some of the people who are promoting a vision of decentralization will actually behave consistent with the vision that they say is important to them. Because ultimately, if they don't, that project will fail. In a sense, the ecosystem will fail. That's my concern, because I do want to see a world where we're not enslaved by centralized authorities. I do think we need a check and balance. And so we need some competition between decentralized and centralized institutions. An example I refer to a lot is Uber. Uber just announced that recently after the IPO, the CFO acknowledged that Uber might never make a profit. So so the Uber driver essentially has contributed a lot to the success of Uber, and they've gotten no benefit from contributing to the success. There's an inherent conflict of interest between those that provide capital and those that work every day, as free agents in Uber. So far, they've had success in creating a lot of free agents. And what they've done is every time to create more value for them, they've had to basically reduce the compensation of these free agents, for the benefit of the venture capitalists. So essentially, with people who are participating in the ecosystem, there's not a very good risk-sharing, risk-reward system. And if we could create a decentralized Uber, where basically drivers as basically providing proof of work by where they're driving, which is completely easy to validate, can earn tokens in Uber. And therefore, venture capital needs to put less money in, and the drivers are putting sweat equity in by their contributions by being part of the system. Then we can redistribute value differently, and then we've aligned people's incentives differently. And so I hope to see instead of Uber, the few Uber investors getting super rich by having Uber drivers earn below minimum wage, I don't think that's very healthy for us long term as a society. I don't think that'll preserve viability for us as a people. If people design platforms where 3 or 4 people get very rich and everybody else is earning below minimum wages in order to sustain their lives, I think that's unsustainably socially. And I think a lot of that outcome is really associated with an absence of bargaining power. So, and an ability to distribute value in a fair way. A lot of the value of Uber today has nothing to do with Uber. Okay, it has to do with zero interest rates. So somehow the value of zero interest rates is only benefiting the Uber shareholders. Okay, it doesn't benefit anyone else in society other than the financial class is being benefited by zero interest rates, because we know if the Fed was to raise interest rates to 5% or 8% or 10%, okay, Uber would not be able to do an IPO, and Uber would be dead as a company. So their life as the company has nothing to do with decisions any executive is making. It has to do with the fact that since 2008, the Fed has intervened in such a way that has created a bubble in asset prices that has benefited very few people.
And we have a question from the audience, from Alex. And the question is, what is next after IEO? How will exchanges pump their token and get people excited about listings now that IEOs are fading out?
I think, I know a lot of people with a lot of liquidity, okay, with a lot of money. I know a lot of investors, a lot of money. I'm always looking. I have more money than I can find good ideas. Okay, so the issue is not the form in which I raise money. The issue first is the quality of the idea, and then the character of the people who have the idea. So I think generally people with good character that have a really good idea, okay, on the most part, I don't think I have a difficult time raising money. I think as you go down the quality curve, the more mediocre the character and the more mediocre the idea, the harder it is to raise capital. And I can understand people who are mediocre of character and mediocre in quality ideas still want to have access to capital and want to find it anywhere they can. And that's human nature, and there's nothing wrong with it, that they search for somebody who will back their idea, and that they look for any sort of financial innovation that'll give them access to money cheaper and on better terms from their perspective. And unfortunately, that generally means going down the curve to less sophisticated investors, and hopefully a less sophisticated investor will understand their own limitations and get the right guidance before making their own. And if they don't, then it's their responsibility. Look, governments sell lottery tickets, okay? So lottery tickets have a lower expected value than I would say an IEO or an ICO. And I don't see that when you go to a corner newsstand and buy a lottery ticket, I don't see the fact that they've had that person at the newsstand trained in explaining to you the risks associated with the purchase of that lottery ticket. The governments advertise lottery tickets, and they advertise how big the potential payoff could be by buying these lottery tickets, okay? And the government doesn't care if you take 100% of your money and invest it in those lottery tickets. So the government doesn't really care about protecting the small investor. If they would, they wouldn't be issuing lottery tickets and encouraging people to buy lottery tickets. And they understand that it's the least sophisticated investors that are buying lottery tickets. So the government doesn't give a shit about the small investor. They just want to profit off of it. They don't mind the lottery ticket model because they're the beneficiary of it. So let everybody else be the beneficiary of something that they want to be the beneficiary in. And I'm sure if they did, people would learn. And people would learn pretty quickly. And the marketplace would continue to evolve in a way, like biology, is that ultimately organisms, get stronger. And if they're left to their own mechanism to do so. And so, because then more people will speak out, more people will have more education, and over time people will make better judgments and learn. And that I'm optimistic about. So I don't find these innovations unwelcome. I'm just hoping that people will think more about them so that they will make smarter decisions.
And what's next? What's your opinion, Grant? How would you answer this one? Jeffrey is optimistic.
Yeah, so we mentioned that exchanges do benefit right now the most. So, and it is good to know and to believe that industry is learning and investors are learning. But right now, and here and now, exchanges are benefiting. But won't it change drastically when soon the hype around IEOs will fade and everybody will see that tokens are just losing their prices. Won't it, kick exchanges from, the other side?
One thing that I love about this particular industry is it's sort of a nice experimental ground to test these theories about pure open markets and no regulation. It's pretty fascinating to see how things play out. And one of the things that I think people learn is why we do have some regulations or have some centralized control over these things, because if you don't have some degree of control, then it's just a complete Wild West atmosphere. And I would love to see a pure market-based solution where all information is freely available for everybody, because theoretically that's how everything is supposed to work. What happened with ICOs is the fact that people did learn that they weren't good investments anymore, so they stopped putting money into them. And actually, from my understanding, is that the ICO market really tanked out long before the statistics show they did, because there were so many token swaps going on. They weren't actually raising new money. It was just different projects that were running ICOs at the same time were just kind of giving tokens to each other, and they were booking those as money coming in. But regardless, investors learned these are not good investments. Don't want to do them anymore. So and I saw a shift to security tokens as being the next big thing. STOs or the ICOs 2.0. But people realize, well, they're kind of expensive and it takes too long, and it's it's still developing. And I think that's STOs are still, or digital securities offerings, they're still cooking in the background. So we shouldn't write those off at all. I think they're still developing, and I think the IEO thing, I do believe, is going to be something of a flash in the pan. I believe it will probably increase and go, and it will people lose interest much sooner than they did with ICOs. I think that I always thought that was maybe one of the reasons why Binance's got their decentralized exchange up and running now, because they know that it's just a matter of time before they won't be able to do what they're doing, and they can move on. As far as what comes next, I do personally believe that digital securities, eventually all securities as we think of them now, will be tokenized. I do think that is just a matter of time, but that's different than what people used ICOs and IEOs for, was private raises. I think public securities are going to eventually all be tokenized. It might take years, it might take a decade or more before we get to that point, but I do believe that's the ultimate. That's where this is all going to end up. And then all of the real benefits from tokenized securities, that's when they will really become available, and you'll have more opportunities for people to invest in things that they never had the ability to invest in before. The last point I'll make, because I know we're getting close on the end of time, but it's something that Jeffrey mentioned about the lottery tickets, and that's always been a problem for me too. Why is it possible for people to go to a casino and blow all their money or spend it on lottery tickets, but you can't invest in something that theoretically has probably a better chance that you'll make at least some money back, as opposed to that? And I always thought that a great solution for the accredited investor rule was just do away with that and just basically post the odds of winning, just based historical data, which you could theoretically pull from the blockchain if all the records are on there as far as how much is raised and how much is lost, and just print those in real time, so that people, when they're getting ready to decide to invest, they just look at, okay, well, my odds of making any money on, if I invest in an ICO, is about this much. It looks like a better deal than lottery tickets, so I'll put my money in that instead. And I always thought that would be a great way to solve the problem. I'm sure it will never happen, because then government wants its money from the lottery tickets, so they're not necessarily going to be passing bills to enforce that or to allow that. But I always thought that would be a great solution for that. So that was interesting. But that was it.
Thank you, Grant. I think we're running close out of time. But maybe somebody would have final thoughts.
I would ask Dave to answer the same question, because I think that this is a good way to end. Wrap up the roundtable. Actually, what's next? And we know that Jeffrey is optimistic, and we have just heard Grant's point of view. And now, Dave, what would you say? What we have next after IEOs?
So, I agree with Grant. I think that IEOs are a reaction, and I think Jeffrey would agree with this too. IEOs are a reaction to the lack of other assets taking off, and it's a way to get more activity and more investment. I think he kind of said that. I agree very strongly with Grant that digital assets, so-called digital assets, are the future. And what does that mean? Basically, all STOs are securities in a smart contract form, known as dematerialized, that have one different feature than a regular paper certificate, and that is programmable liquidity that's enabled by electronic trading, and typically for private assets. I mean, the thing that STOs are exciting to me about, well, what makes me excited about STOs is the ability to fractionalize private assets so they can be bought and sold more easily. Unfortunately for the fans of decentralization, I think that DEXs are not the big next thing. I think it's actually the opposite. I don't think that DEXs work very well for trading assets because they're hard for price discovery. Without a concentration of a bid-ask concentration, you can't do price discovery. And without market making, it's hard to actually have a market. So I think that unfortunately, decentralization is not, and digital assets of the securities variety are not necessarily as much of a thing. And so I think what you're going to see is you're going to see some increased centralization. It doesn't mean it's going to be the exact same thing as DTCC and Seed and Co. and the way that broker dealers work with exchanges on Wall Street. But I think you're going to see that companies that are too big to get acquired and too small to go public are going to increasingly think about turning their valuable, meaning you can place a value on them, their valuable assets, placing them on chain so they can be bought and sold. And I think that compared to early stage projects, which are, a lot of them are full of shit, like what Jeffrey said, and I agree with him. A lot of these companies that are worth $300, $400, $500 million, they're very, very valuable companies, but they don't have a venue for being bought and sold right now. And it's not the investors who are really losing out here. It's the employees, the early investors, and the founders who are the ones who benefit most, and who will see digital asset securitization or fractionalization make a real big change. And so I think that I'm all in. I've pushed all of my chips into the middle of the table for tokenization of real world assets and venture funded companies. And I think that's the next big thing. So I want to thank you guys for putting this on. I'm lucky to get to share this time with folks who are smart like Grant and Jeffrey. And thank you for creating this venue for us to trade our ideas in a decentralized fashion.
Thank you very much, everybody.
Can I say one more thing?
Sure.
Just what I'd love to know, I'd like to be able to say that IEOs are working the way they're supposed to be. But again, my concern is the lack of transparency. So if there is anyone watching this who's worked with a project that got listed on IEO, I would love to learn some information about, how much did they raise? How much do they get to keep? Are they working on their project? Anything like that. So if there's anybody who's watching has that sort of information, I'd love to know about it, because then as someone who is often asked for advice whether or not to do an IEO, I'd love to have that information so I can give a more informed answer. So that would just be my request to anyone in the audience watching. But
hey, Grant,
thank you. Yeah,
Grant, let's work on one together. I'll talk to you offline. Okay. We can do that together.
All right. Sounds good.
Okay.
I'd like to add something else too.
Please do.
I think from the purposes, I think short run, I agree with Dave said about increasing centralization, but the centralization model is predicated almost 100% on very cheap access to capital, supported by fiat paper money. And what will happen if that game runs out? So is there a limit to how much money creation there can be by central banks all over the world? How much liquidity creation there could be that basically support asset price inflation? a bubble. As Hayek said, the cause of the bust is the bubble. So to the extent that if you believe the central bank has created a bubble, which I think they believe, which is the reason why when they started raising interest rates and they saw the reaction of the capital markets, they immediately pulled back on interest rates. And now I understand more people are betting that they're going to likely cut interest rates than raise interest rates because of how fragile the economy seems to be. So we have a whole system predicated upon the government spending lots of money all over the world, and the government expanding and central banks expanding their balance sheets. We don't know what the limit to that is. Okay, whenever we reach the limit, okay, the likelihood is if the low cost of capital game ends and cost of capital gets repriced and risk gets repriced, many businesses will be out of money and they'll go bankrupt. And the valuations of companies that right now, the Teslas of the world, the Ubers of the world, the Netflix of the world, companies with huge market caps that have never demonstrated any capacity to make money, and nobody knows how they ever will make any money, that if they have a company that's not making any money with a significantly higher cost of capital, what will that do to the valuation of those assets? And what will be the consequences of, people working for those entities and how much they'll get crammed down. So I think ultimately people will begin to reject the centralized model and move towards a decentralized distribution of value. And that's why you see, and I'm not a socialist, and I don't support socialism, but it's the reason why there's a growing demand for socialism. As you see in the United States, as you see in Spain, there's a growing demand for socialism because more and more people think that the outcomes associated with our economic processes are unfair. And I think there's a legitimate argument that they are unfair, and the outcomes have been different since we engaged in this fiat money regime. The type of outcomes we have on distributions of income and wealth while we under a gold standard was very different than when we removed ourselves from the gold standard and basically had financial capitalism become a significantly higher component of the wealth creation in our society. The financial system profits as a percentage of GDP when we were under gold standard were under 5%, and now they're over 15%, over 20% in many countries. So that wealth, since we haven't created a lot of wealth, we've redistributed wealth in a very significant way, and we've redistributed away from labor. So if you look at labor's claims to wealth as opposed to the financial system claims to wealth, the big winner has been the financial system, and the big loser has been labor as a result of fiat money. So when the fiat money game ends, we might see a different organization of companies, that they might have innovations that I think will end up rewarding decentralization, because people will ultimately reject the centralization, because in the beginning they will enjoy the efficiency gains associated with decentralization, but those efficiency gains are only captured by 0.1%. So most of the people don't benefit from those efficiency gains, only a small percentage do. And so I think in the intermediate to long term, people will reject that, and I think the increased centralization will end up being in the increasing decentralization, but it'll just take some time.
Thank you so much, Jeffrey, for adding this. And I guess we'll call it a day. And thank you very much, everybody, for joining us here on the first roundtable. We were very excited to host you here. And I think just for anybody, if there's anybody in the audience who lost money on IEOs, we have some good attorneys. And we'll post the video will be on our channel, the recording of this live roundtable. Please like and subscribe if you like what you heard. And thank you very much, everybody. It was very interesting, very valuable opinions. So we will see each other of you very soon.
Thanks so much.
Bye, everyone. Thank you.